This program is made possible by Centier Bank and PSCA, the Plan Sponsor Council of America. Centier Bank, serving Northern Indiana with 46 full-service banking centers that offer business, personal, mortgage, and investment services. Centier, locally owned and operated for 119 years. For over 60 years, PSCA, the Plan Sponsor Council of America, has served retirement plan sponsors through education and research. Information at psca.org or 312-419-1863.
Welcome to this episode of Money Sense. I'm your host, Anthony Contrucci. The new three-legged stool in life, as it pertains to total wellness, consists of financial wellness, physical wellness, and behavioral wellness. Money Sense was created to help our viewers begin to create a plan for their own financial wellness. Studies have shown that financial stress can lead to illness, reduced productivity, and increased distraction. This series brings together experts to take a common sense approach to helping people better understand a variety of financial wellness topics. Each week, you will meet and hear from industry leaders who will explain the basic concepts you need in order to find your own sense of financial well-being. This week, we'll be covering the topic of insurance.
Welcome to this edition of Money Sense. Hello, my name is Larry Myers. I've been in the insurance business for 39 years. For many, insurance is the most misunderstood product or service that they purchase. It is, however, a very vital and important product. It protects one's assets, such as your home, automobile, and other personal belongings. Insurance also protects you against liability exposure for incidents such as an at-fault accident where you've injured another party or damaged their property. My philosophy on insurance is to protect one against the catastrophe. Buying first dollar coverage is very expensive, whether that be for your home, auto, or even health insurance. Understanding one's tolerance for risk is important when determining how much insurance to purchase, what deductibles to have. When considering the amount of insurance to carry on your home, be sure that you have adequate limits. When a loss occurs, the last thing you want to hear is you don't have enough insurance. Purchasing those higher limits is relatively inexpensive and provides you with the satisfaction and financial protection of your assets that is necessary so that you do not incur financial hardship. Remember that insurance provides protection for your well-being and financial success.
This week, our guest is Mark Bates. Mark Bates is president of the Pinnacle Insurance Group of Indiana, with offices in Crown Point and Hobart. Founded in 1942, the agency is one of the largest independent insurance agencies in Northwest Indiana. Mark, a 25-year veteran in the insurance industry, has always taken a holistic approach to servicing his clients' personal and commercial risk management needs. Thank you for joining me today, Mark.
Thanks, Anthony. Glad to be here.
Great to have you. So, you're here to talk about the topic of insurance, one that is truly near and dear to my heart.
Right.
And insurance obviously is there to help us manage risk. So, what are the main areas of risk you can share with our viewers today that they should have on their radar?
That's a good point. I think a lot of times people have a misconception about insurance. They think that it's a commodity. And oftentimes they don't look at the importance of it to manage their own risk, their assets, to protect their assets. So we try to look at that in a manner of looking at their automobile insurance, making certain they have high limits of liability. Mm-hmm. In this environment, we're in a very litigious environment. So I think it's important that they take that time to understand the carrying that protection there. We see on the homeowner side, obviously property, it's no secret we're having more catastrophic losses, tornadoes. Mm-hmm. Costs are rising. How do you manage that cost as a consumer? So we're looking at different ways to do that through higher deductibles, self-insuring certain areas. The other component is an umbrella policy. People work very hard to accumulate their assets over their lifetime, and in a matter of seconds, that could be all taken away if they do not have the proper insurance.
Okay. So we're going to start to drill down, but before we do, one thing I want to maybe stress for a second and get your kind of opinion on is I think a lot of people think of insurance as this set it and forget it type thing, where you meet with your insurance broker, you buy a bunch of policies, and then they kind of just they don't talk to their broker again, and it could be a year, it could be 2 years, et cetera. I tend to personally look at it as it's your risk profile, if you will, is ever evolving. So can maybe you speak a little bit to maybe some advice for our viewers as to how they can be maybe more proactive and to then kind of combat that ever evolving risk profile?
Well, I think a lot of times people accumulate things over time, and oftentimes we're the last to know about it.
Which would be a problem.
Well, it could be, yes. I mean, for instance, someone buys their wife a piece of jewelry over Christmas. They don't think about calling their insurance agent. That could be a problem, and that's where a loss could occur, something of that nature.
So how frequently would you suggest, because again, if you don't build it, you don't do it, right? You don't schedule it. So would you suggest that typically, our viewers should be talking with their maybe insurance brokers, is it annually, semi-annually? Any best practices?
I think it depends on the type of individual you're talking to. Some may need a semi-annual review, depending on their asset base. But we often see that more on an annual basis, where someone sets up a time to get with their broker to go over their personal insurance program. So it's more on an annual basis, typically for the middle-class consumer.
Okay. Now, you mentioned, going back, we talked about some of those major risks, and it sounds like you covered automotive, homeowners, scheduling, correct?
Right.
Of maybe personal assets and then the umbrella. So now, what are some of the insurances that you use to then manage that? Like, for example, what is homeowners insurance?
Well, I mean, homeowners can be a component of different factors. I mean, obviously, if someone's renting an apartment, they need renter's insurance to cover their contents. If they have a owner-occupied home, they need a homeowner's policy to protect, their dwelling, their contents, and obviously, liability is part of that as it is with renters. The other component would be if someone has a condominium, is making sure they have proper coverage in that respect. So there's usually three components there on the homeowner's side.
Okay. So now, for the homeowners, what are those three components of coverage?
Well, obviously, if somebody has a single-family dwelling, you've got your dwelling, your contents. They may have scheduled property, and then obviously their personal liability to cover in the event of a loss that occurs on their premise, or it could occur off-premise that they're responsible for.
And now, what would you say are the big differences between, again, homeowners, because someone's watching this, let's say in Northwest Indiana, probably a large percentage of homeowners, single-family homes, owner-occupied, I think was the term you used. If someone's maybe in one of the, in Chicago, for example, in a condominium, what are some of the big differences between the different coverages they should be aware of?
Well, for instance, talking about a condominium, a lot of times people do not look at, their brokers never ask to look at the bylaws and covenants. That's effectively what triggers coverage, what the condominium owner is responsible versus his association. So I think it's also important to always make certain that broker has that information to review and make certain, because in a condominium, you're insuring not only your contents, but some of your build-outs, your fixtures, your cabinetry, marble tops, anything of value there, that has to be insured by the condominium owner, not the association. So I think that's important by reading those bylaws to see exactly what they're responsible for.
Okay. So you've talked a lot about, the interior and some of those personal items, personal property. I know you mentioned earlier jewelry, that husband that bought his wife that piece of jewelry for Christmas, let's say, for example. How do you cover items like that? I've heard the word scheduling used before. Is that the accurate term?
Well, effectively, when you schedule, we would need to see an appraisal. And take that appraisal, and then we're going to insure it for that amount. So if that ring was worth $10,000, and that appraisal is for that amount, they're going to insure for that. And what's good about having something scheduled, you're not subject to your homeowner's deductible.
Okay.
So they waive that deductible when it's scheduled, because the burden of proof is on you that you own that item when you have a loss. When it's scheduled, it's already proven that you had it. So that's also very good in having it scheduled. The other component of having something scheduled is mysterious disappearance typically is not covered for unscheduled items. So, like if you had that jewelry and you had that diamond fall out of it, we can still be able to provide that coverage when it's on a schedule. It's typically covered.
So, devil's advocate, okay? So you have this ring, $10,000 value, I think you said,
Right.
It was appraised, that stone falls out, but you insured it for $10,000, and now let's say to replace that 5 years later, 10 years later, 20 years later, it's double, it's $20,000. How does that work with the insurance that you have?
Well, that's interesting you bring up that point, because people typically may buy that ring when they get engaged for their spouse.
Correct.
And 20 years later, something happens to it.
Mm-hmm.
The price of metal has went up.
Right.
So we always recommend people getting appraisals every probably 3 to 5 years, typically depending on the value of that item, and to make sure they've got proper insurance on that, because in that case, using that, if they had that $10,000 ring and it's probably worth, say, 15,
Right.
10 years later, it's too bad.
Okay.
They're only going to pay that $10,000.
Okay. So, interesting. Are there ways of preventing that? Are there ways of, for example, let's actually go back to homeowners.
Okay.
I think it's kind of, 'cause I'm thinking this, finding this interesting theme here. So, with your home, does the same thing hold true? You have that home. It was appraised when you got your insurance for $250,000. Now, God forbid, there's a fire, but now to rebuild it, it costs more.
Well, that's what we call insurance to value.
Okay,
Making
interesting.
certain
Insurance to value.
people are insured to value. So, for instance, typically when a client comes in, we're going to evaluate the risk based on square footage,
Okay.
The year it was built, the updates, how, when the roof, and, all the components. Is it a custom-built home? A custom-built home has different interiors than maybe what a builder's grade type home may have. So it's important to know all that to make sure then we're insuring to value.
Okay.
Because you want to insure for replacement cost
Okay.
effectively. And that's what we're driving to make sure somebody is not underinsured.
So I remember hearing a story a while back about someone that, same scenario, had that home maybe they built for themselves, custom home that they loved. It really was their home, burnt down, and just because of the trauma, they didn't want to rebuild on that lot in that area. How does that work with insurance?
Well, it depends on the carrier, but
Okay.
some carriers, particularly, let's say we've got a high value dwelling,
Okay.
let's say $1 million or higher, and you
Okay.
may see that more typically, and we call that a cash out option. So if that person had that big home for 20 years and their kids are gone, they may not want to rebuild. They could effectively take a cash out option, depending on the carrier, if they have that in special endorsement. And effectively, if that home was insured for $1 million, they could get a check for $1 million and walk away. And then if they, say, relocated to Florida, it wouldn't matter. Wouldn't matter. And that's a nice feature. But in the case with most carriers, if that scenario would occur, then what a carrier, they're not going to give you that replacement cost. They would give you actual cash value. So the replacement minus the depreciation for that actual cash value. So
Okay.
there's two different ways that could be settled.
Interesting. Okay. So when it comes to homeowners insurance, are there, this show, Money Sense, really
Right.
is about, what are the misconceptions, what are some of the frequently asked questions, and what are things that, people within the confines of a 30-minute show should really know?
Right.
Are there, 2, 3 things that you think are really important to address today on Money Sense that the average person is just not on their radar as it pertains to homeowners insurance?
I think one of the very overlooked coverages is water backup of sewers and drains. People think, well, if a sewer backs up into their home, there's coverage.
So is that flood insurance then?
It's different.
Oh, okay.
And flood insurance is excluded under all homeowners policies. That's administered by the National Flood Insurance Program. So there's no homeowners policy that will cover flood. That's a separate policy in itself. But water backup of sewers and drains, people may have a finished basement. And they spend a lot of money. People invest a lot of money finishing their lower levels. And they never think about that bad storm comes through, the power goes off, the sump pump's not working.
Doesn't kick on.
It's got to go somewhere, and it's going to come up through the drains. So it's important to protect yourself in that respect. People say, well, I don't have a finished basement. But usually your furnace, your water heater, all that items are in the basement. They could still be damaged. So you need to have proper coverage in that respect.
All of that equipment that
Absolutely.
still adds up to a lot of money at the end of the day.
Right. I mean, a lot of people think, well, it's just storage, things that I do not need and it's in the basement. And that's true, but there's some value there too.
Right. No, good point to think about. So I know we're talking about insurance and working with brokers, but then you used a term earlier in the show, self-insuring, and something about, deductibles and your premiums. Can you maybe talk a little bit more about that?
Well, I think a lot of times as insurance costs have risen over time, I think people become, how can I cut my cost? And
but by cost, break it down, that's the premium you're paying.
The premium,
correct?
exactly.
Okay.
How can I cut my premium cost? And oftentimes, it used to be years ago, people had a $100 deductible. Well, that's a thing of the past on an auto or even a homeowners for that matter. Typically, we're seeing higher deductibles, which if you get up to $1,000, $2,500 deductible on a home, for instance, you're going to see a significant savings for yourself in that respect. On the auto side, we see people carrying usually $500 to $1,000 deductible. And depending on the individual, their appetite for risk may be greater. They may say, give me a higher deductible. They can self-insure for that big major loss. And so it just depends on the risk appetite of that individual or what they want to do.
So it sounds like, in so many words, it's, if you're willing to increase your deductible, you'll see this decrease in the premium that you're paying, so you're actually paying less.
Exactly.
And willing to take on and absorb some of the cost in the event of there being a major issue.
Exactly. And I think the probability of a homeowner's loss is less likely than an auto loss because our cars are out on the road every day. So typically people tend to carry a little bit lower deductible on the auto than they would typically on the home.
So speaking of auto, I'm glad you brought it up because I just feel like, myself, and viewers probably included, we're kind of sometimes feel like that's where we know probably most of our risk lies. I feel like I don't know if I'm covered properly. What are some of the key things I should know about auto insurance and knowing if I'm covered or not?
Well, that's a good point. I think oftentimes, and I alluded to it earlier, is limits of liability. In the state of Indiana, our minimum limits are $25,000 for bodily injury.
Okay.
One accident could take that pretty quickly. We don't see that too often with people. Generally speaking, we'd like to see people carry limits of a minimum of $250,000 each person for bodily injury.
That sounds like a lot, though. Is that something for the average person? That's an appropriate level?
I think in today's environment, the difference, probably the lowest limit I would recommend is $100,000 for bodily injury, $300,000 per accident, $300,000. But in this environment we live in today, it doesn't take long to, if it's a serious auto accident, if it's multiple cars and you're determined at fault, there is an exposure to that individual.
You've mentioned, a couple times, that home that maybe the $250,000 value versus the $1 million home and how sometimes coverage can vary, the carrier maybe they're using, et cetera. How often does that work into the equation when you're trying to create this kind of comprehensive, total kind of risk management for a client? How much is maybe their net worth, their level of investable assets play into that?
I think that's definitely a factor we look at. And I think oftentimes people, let's just take an average middle class family at that $250,000 home. Their risk tolerance is going to be different than perhaps that individual who has a higher valued home. So we counsel those individuals, what is their risk tolerance? And that's where we try to balance those two and ask the proper questions to them. what are you willing to take on in your own pocket in the event of a loss versus having the insurance carrier pick it up from dollar one.
How do these insurance companies, or I guess I don't know, the underwriter or the carrier, how do they price these auto policies for people?
Well, I mean, there's so many different factors that go into rates. The rates are predicated on the type of vehicle. For instance, if we're talking about auto insurance, the type of vehicle, the age of the operators. Even today, underwriters are looking at their educational level.
Okay.
There's discounts available in that respect. We see, obviously, tickets and accidents. Credit scoring is a huge underwriting component of auto insurance and even homeowners insurance today.
It's interesting you mentioned that, because one of our previous episodes we talked about, your credit score, basically, understanding your credit, debt in general. And it's interesting to see how it's really this web that all this kind of weaves in together.
Yes.
You're talking about your total wellness and total financial wellness. So everything affects everything else.
It is, and credit scoring became a law in Indiana in 2003. Okay. And it's used as a component of underwriting. Obviously, they still look at tickets, auto, losses and that type of thing. But credit is becoming more and more a key factor in what the rates are determined for an individual. The same individual that has that 2014 Chevy Impala, and they're the same age, they could have two separate rates, and the underwriting component will be that credit.
Okay. So we're talking about auto insurance, and this, I think, is tongue-in-cheek, the $1,000,000 question.
Right.
Because I do enjoy traveling, and you go on vacation, you get that rental car. You never know what to do. Do you take out, pay a fortune for the rental car company's insurance? Do you not? Any
There's a
pearls
lot.
of wisdom?
We get calls on that
Okay.
pretty frequently, particularly when the summer rolls around. But that's an area where people need to look at. If they have full coverage on their auto, obviously the liability will automatically extend if you rent a car.
Okay.
What people need to understand is you need to make certain you have physical damage coverage, comprehensive and collision coverage. Then you can waive that coverage from the rental agency. But there's pros and cons in that respect, because I see oftentimes people generally will waive it, but what they don't think about is the coverage in the event, and there's actually no coverage in a personal auto policy. If you waive the coverage and you have an accident in that rental car, the downtime while that car is being repaired, you're responsible for that.
Oh, interesting. So you have to make sure.
So if you, in that flip side, let's say I'm going to take the physical damage from the rental agency. I wreck that car. I just turn it in, and just like you do when you turn the car in, it's on their dime, not yours.
Okay. We unfortunately have a couple minutes left, and one thing I think is important to address today is, these umbrella policies. And again, it's not raining in here, but what is an umbrella policy? I've heard so much about these.
Well, it's certainly a coverage that is excess over your auto liability limits and your homeowner's liability. So let's say you have $500,000 liability under your home, and you purchase a $1 million personal umbrella policy. You effectively have $1.5 million of coverage. So it's coverage in excess of what we call the underlying limits of the auto and the home. And we see too often people don't think about the catastrophic, and as I alluded to earlier about, in a second, someone's life could change in the event of a serious auto accident or a homeowner's. People have a pool. They don't think about protection in that respect.
So we have about a minute left. Can you give us maybe an example of how an umbrella policy can really, just help you so very much and prevent you from some catastrophic risk?
Well, I think it's pretty simple. We've had situations where people have had a serious auto accident, and let's say, for instance, they have $250,000 on liability, and they had a judgment against them for $500,000.
Okay.
Where are they going to get that money? They're going to come after you personally. If you had an umbrella policy, they're going to pick up that extra $250,000 out of that $1 million umbrella. So that gives you that cushion and that protection in the event your underlying limits are not appropriate. or sufficient, I should say.
Okay, that's interesting. So it sounds like it's, I mean, are these very expensive? Or?
Absolutely not, and I
Okay.
think that's where people have that misconception. An average cost of an umbrella for 2 autos and a home may run $150, $175 a year.
So a pretty inexpensive way to really save yourself a lot of pain potentially in the future.
Absolutely.
Mark, thank you so much for your time. And thank you for joining us today. Hope you had as much fun as we have. We look forward to seeing you next time for a new episode of Money Sense. I'm your host, Anthony Contrucci, and remember, we always try to make finance fun.
This program is made possible by Centier Bank and PSCA, the Plan Sponsor Council of America. Centier Bank, serving Northern Indiana with 46 full-service banking centers that offer business, personal, mortgage, and investment services. Centier, locally owned and operated for 119 years. For over 60 years, PSCA, the Plan Sponsor Council of America, has served retirement plan sponsors through education and research. Information at psca.org or 312-419-1863.